Everyone, this is Professor at MoneyPigTrading. Today we're going to talk about how to trade option, and this is episode 1 as how to long call options, and we're going to use Amazon 1000% trade as an example. And if you're watching this video, you're about to open a new world with endless opportunities. Especially options are highly flexible. But really quick, we're not financial advisors, so please invest at your own risks. We're here to provide trading education. If any question, feel free to reach out at www.moneypigtrading.com. We have a robust Discord community, and we also have Twitter, YouTube, and Instagram, MoneyPigTrading, and feel free to reach out there. So in this series, we actually have 15 different episodes. We're going to talk about what are call options, put options, what are the vertical spread, butterfly, iron condors, and any other many other option factors that you should know when you trade options. So what are the options, right? So basically, options give you the right to buy an underlying assets at a predetermined price before the expiration date. So the underlying asset could be stocks, but also can be any other thing like cryptocurrency. And a lot of people are asking like, oh, why you haven't invested a lot in cryptocurrency? Because in a lot of crypto wars driving me nuts is there's really no robust options for me to robustly hedge my big crypto position because things can go wrong in your crypto assets or any other investment. And with options, it can protect and give you a hedging position. Like if you hold a lot of Bitcoin, you have just a little put options to protect when the crypto price drop, Bitcoin price drop significantly, because your put option price will go up exponentially in the meantime to offset your underlying stock or crypto position. So the first usage for crypto is to hedge, right? And also in our swing trading or momentum trading situation, option trading can provide higher risk and higher return trades, and we're going to provide details down the next few slides. And there's another very popular strategy we call wheel strategies. It's basically using an option to provide steady income generation, and we're going to talk about it in the next videos. And basically, options are highly flexible, but also very complex. On the left side here, we're looking at the chart, right? Typical asset price versus time. A lot of people are making charts on this type of analysis, doing technical analysis. And if you're thinking about stock, we also need to consider the market, the general market condition, and also for that particular asset, probably has a whole sector behind it. So we have to analyze the sector performance as well. And also for any assets, volume also is a key, right? So if you're looking at the stock itself, there are several factors, and that actually a multi-dimensional problem already, making kind of complex. But if we're looking at options, it's actually way more complex. Not only we need to look at the same factors like we're looking at just like a typical stocks or cryptocurrency, we also need to consider the option types, right? Like call, put options, but we also have like vertical spread, iron condor, butterfly, blah, 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 right? And also, actually, in the next video, we're going to talk about Greek ladders as well. That's several other pretty important statistics behind the option contract that you need to know before you're buying an option contract. And the other thing you have to notice is implied volatility. This will heavily skew the option price in a particular event. If the higher it is, that means more volatility you're going to see for that particular option contract price. And with all this factor together, you're going to get your option price. So in this kind of option, or with somebody called derivative trading, is a very complex, multi-dimensional problem. To highlight this is not to scare you away, but instead just trying to show you how complex options can be. And humans are really not good at multi-dimensional problem, and that's why data science and our Discord community come here to help and providing those education contents. Hopefully it could be a little helpful. And because options are so complex, it's actually making a lot of flexibility, and you can probably see in the next video to serve the purposes in the three option purposes I mentioned in the previous slide. So here we're going to talk about long call options. Basically, is somebody called a naked call as well. Basically, it's an open-ended option contract that bets on the underlying stocks or cryptocurrency will going up. And if the stock underlying assets go up, your call options price is going to go up exponentially. Okay, let's take an example for Amazon. We make a lot of videos about Amazon because there's a lot of trading opportunities here. On March 30th, our AI model actually detected that Amazon's going to go up. So if you want to take this opportunity, you buy the naked call options and you're going to make some decent profits. And here, about 7 days later, Amazon actually did went up from 31.30 to 33.72, in case you cannot read it. So if you're looking at an option contract, basically the syntax is, the first one will be a ticker. It's the underlying process, stock assets. That could be a stock, can be a cryptocurrency. And the next thing you will see a date, will be a month and date and year. Basically, that's the expiration date of the option contract. After that date, the option won't be tradable at all. And the next thing you're going to see is a strike price. What is the strike price for that option? If you hit that strike price, you can exercise that option. We call it in the money contract. And the last one, the symbol is type. So basically we have call option, basically betting on the underlying asset will go up. Put option on the vice versa is betting on the underlying asset will go down. So here's an example. The ticker is Amazon. Expiration date for this option is April 16, 2021. Not tradable after this particular day. And here the strike price is 3,300 and is a call option. So it's a C. That means we're betting the underlying asset will go up. So again, in the money means if the underlying assets price is actually above the strike price. Here, if Amazon is traded above $3,300, the stock price, if you're holding this April 16, 2021, 3,300 call, that means you can exercise these options and buying the Amazon shares, right? Because at the beginning we mentioned the call options give you the right to buy the underlying assets. So here, anytime before or on the expiration date, if Amazon is traded above 3,300, we call this option contract in the money. Vice versa, if the underlying asset price goes below the strike price, we call it out of money options. Sorry, just make a really quick correction. So the long call options here is basically, if you're looking at the trading opportunity we mentioned the 2 slides ago, basically if you just long Amazon stocks on March 31st, your entry price will be 31.61. On April 9th, Amazon actually went out 33.54, and basically your return is 6.1% on the stock position. However, if you use Amazon April 16, 2021 expiration, 3,300 strike price call options, betting on the stock price to go up, and you enter, like myself, on March 31st, 2021, and $7.2 per contract. By April 9th, that option contract goes up 1,082% to the price of 77.87. You will say, how could that be possible, right? And that's the power of derivative trading. And momentum trading is, if you use open naked long options, when your direction's right, your return is going to be amazing, but you are going to expose a lot of risks as well. So when you look at the thinkorswim, this is a mobile platform. You will see the same thing I just mentioned, the underlying assets, the expiration date, the strike price 3,300, and this is a call option. And when you're looking at this, like this is one of the contract I own in one of my account. I bought this option at 9.3, and you will see the strike on April 9th, this option is actually traded at 77.87. So yeah, this pretty decent return. You will see the panel, the profit and loss here, the P&L is almost $7,000. So in our Discord community, we sent out the alert on March 31st. We actually entered this 3,300 call at 7.2. And on around April 10, we actually sold that contract at around $73 per contract as the last contract. And we usually add gradually and take profit gradually as well. So in this particular screenshot, you were seeing the entry price at 9.3, but the very first contract will actually enter at 7.2. So how could that happen, right? So when your contract actually get into the money, on the left side is the Amazon stock price on the between March 26, 2021 to April 15, 2021. And it's the same time frame on the right side, which is the Amazon April 16, 3,300 call options. And this is the same time frame compared to the stock. And you can see when we entered the position, it was at around $7 to $9. And at one point, it actually went all the way up to $140 per options contract, which is ridiculous. We will kind of take profit too early around 70s. But if you're looking at this particular contract, why it can go up so exponentially? Because once your contract get in the money, which is 3,300, which was reached on April 7 when Amazon was traded at 3,300, once your stock option goes up to become in the money, $1 of a stock, Amazon stock goes up, your option going to go up $1 as well. And remember, each option contract gives you the right to buy 100 underlying assets. So in this case, every $1 Amazon stock goes up, once your option goes in the money, your option will go up $1 as well. And this $1 multiplied by 100, that means $100. So every time Amazon move out $1 per share underlying stock, your option is going to move out $100 per contract, which is ridiculous, right? So imagine once reaching 3,300, Amazon actually traded around 34.30, which is about 4 days later, right? Once your option getting the money, that means your option price from 34.30 minus 3,300, that's $130 per share underlying stock price move. Multiplied by 100, that means doing this $130 Amazon stock moving up, your option contract actually move out 130 multiplied by 100. That means $13,000. So that's why all this option price can go up exponentially when the underlying assets goes up. However, on the other way also works as well, right? When Amazon traded at 34.20, it quickly pulled back in 2 days to around 33.40 level. And you can see your underlying options drop from the top $140 all the way to $40. So if you buy the option contract on the top at $140 per share per contract, it dropped to $40 per contract in a matter of 2 days. And that means you're losing about 70% or $10,000 per contract in a matter of 2 days if you capture on the top. So a naked call option, when doing a momentum trading, when you're getting a right trend, you're going to have a handsome reward. But if you're getting in it too high, you chase the price and the underlying asset price action go against you, you're going to lose money really quickly as well. So it's a high risk, high return trade. And that's pretty much the high level of how to trade call options. Just want to highlight, we have a Discord, a long-term investment program with a pretty decent average return per trade and winning rate. And we also have a momentum trading based, option based swing trading programs have a really decent winning rate and average return per trade as well. So any question, want to try out our Discord community, make sure to check on www.moneypigtrading.com. Any question, feel free to reach out down below in YouTube and follow us to get the latest content, or Twitter and Instagram, MoneyPigTrading. Thanks for watching. I'll see you guys next time. Bye.